this document is over 1,000 pages. And so in our 20-ish minutes together, we are not going to cover off all the details in these 1,000 pages. But what we do want to do as 3 certified financial planners is talk to you about some of the highlights. Specifically, a lot of the aspects of the Big Beautiful Bill were adapted or related to the TCJA, Tax Cuts and Jobs Act.
What does that mean?
Circa 2017, which was another big bill that was in place in 2017. And there's some related topics that we also see in the Big Beautiful Bill. And so we have kind of hand selected some of the highlights that we're seeing that might be applicable to our listeners. And we'll probably do podcasts again in the future, right? Or shows in the future to talk about some of these highlights. But let's dive into some of the topics that we know so far from the Big Beautiful Bill.
That's right. There's some good ones. Well, and I think as you said, Laura, the full caveat is this stuff's brand new, right? So any listener, talk to your tax professional, talk to someone who knows your specific situation and whether these apply to you or not. A lot of these have limits and caps and caveats, and all that's kind of buried in the bill. So, just as we're digesting it, there's a lot of tax professionals who are working through this to figure out how to best serve their clients. The ones that we picked are not, exhaustive. There's a lot more in the bill. We just picked a few that tend to be more relevant for the types of clients we work with, just to make sure that these are things that pop out. So,
or just an overall impact on the economy that we think would be relevant.
And let me say this, for me personally, the primary push on this is to make the tax cuts that came in the previous bill permanent. And so that they were all supposed to expire, which would have changed everything. It would have changed a lot of people's filing. So that was a big deal to make that. So that was a big part of this bill, was to make those tax cuts, brand them in there.
Yep.
It's permanent. It's permanent until the next time that Congress meets on them, right?
Well, then let's not bury the lead, because there's one right at the end that I actually think is helpful to state right at the beginning, which is the rule with the estate plan exclusion, right? So the estate and lifetime gift tax exemption was something that was in the earlier bill, and a lot of people thought might sunset here in 2025, and they weren't sure what was going to happen. But in fact, as a part of this bill, right, they further extended the $15 million for single filers, $30 million. This is estate and lifetime gift tax exemption, $30 million for joint filers beginning in 2026. So a lot of us that were kind of holding our breath.
Well, for most of our clients, what that does is that puts them, the estate tax exemption puts them beyond the reach of their, or I should say the estate tax puts them beyond the reach of their asset base. Because most people don't have $30 million. The vast majority of the people don't have that.
Right. And for the context for anyone who's listening, as people hear about death taxes or estate taxes, eventually, if the estate is very large, then the federal government requires you to pay some sort of taxes as you pass away and transfer your assets to the next generation. This exemption now for a married couple being $30 million, that means for a married couple, if your total assets, your property, your investment accounts, everything, if it's under $30 million, well, then you don't have to worry about estate taxes. Right. And so, as you said, Randy, the vast majority of people in the country, this makes death tax or estate tax at the federal level just a non-event. Which for estate planning, part of what I do is I put together trust and estate planning for folks here in California. It makes it real easy for a lot of families to say we don't have to have these more complex trusts or strategies. So that's a huge one. Had this not been extended, there would have been a lot of people hustling to redo their estate plans. But because
hence the sigh of relief, because it would have added a lot of complexity, a lot of changes on the estate planning landscape for our clients. Yeah.
So that's a great extension. The other one that's related to that is the tax brackets. A lot of the tax brackets, the 22%, 24%, 32%, all those as they go up, they were set to come back down based on your income levels. So there was going to be a big readjustment for 2026. However, those were all extended. And so the increased income levels that keep you at those certain tax brackets all move forward. So that becomes a permanent part of our tax code.
Now, there's some things that I think are a little bit interesting. I'm just going to pull out like one of the curveballs here, but there was a repeal of several, they were called Inflation Reduction Acts, and these were green energy tax credits that had been in place for a long time. And primarily these tax credits were benefiting individuals, and such as like the electric vehicle, residential energy efficient tax credits. And so those are actually going to be repealed after 2025, or it says within a year of the law's enactment. So I thought I wasn't expecting that. I think that's kind of interesting and something to know.
Well, I think Trump's he wanted to do away with all the benefits for electricity and passive energy and all those things. So solar, wind energy, and such. He felt like it was just a giveaway to programs that weren't efficient. And so you hear him saying, when he was running for office, he said, we're going to do drill, baby, drill. And he's pretty much acted on that in the sense he's given a lot of incentive to fossil fuel producers, not only natural gas, but also oil. And not so much to coal, but coal is, I think it's ebbing its way out as far as an energy producer. But at the same point in time, he just felt like there was a more of a incentive, probably an unfair incentive to solar and wind energy and some of these others. Again, they have to be economically feasible. You're talking to a man that's you're talking to a man that trying to looks at the numbers. And he says, is it economically feasible to put our money as taxpayers into, let's say, solar or into wind energy? These big fans that are off the coasts of Massachusetts that even the rich are complaining about. So anyway, there's some changes there, I think.
So the next topic, which I think, did you have something more on that? Go ahead.
I just say related to that one, you talk about electric cars, electric vehicles, subsidizing solar or things like that at your house. But there is one that gets added in that talks about kind of American made or American assembled vehicles that right now, currently, you can only write off interest, loan interest on your home is generally, there's some other caveats, but it's generally you write off home interest. This one allows you to write off some interest on your car loan, provided it's a certain type of car. So what I think is interesting is if someone was interested, say a Rivian or a Tesla or some sort of electric vehicle, wow, like, do I buy it now to get this credit? Do I wait till next year to get that credit? Yeah, you have to find out and kind of wade through what your situation is. But
it depends on if you're planning to finance it. But yeah, that was going to be my lead in. Like, I think it's time for you to buy me that Rivian. Like, I just feel like it might be now might be the opportunity. Just what color do I want?
Are they running big rebates? Is that
really, we need the third row because our family's so big. I don't think we quite fit in the Rivian. But, someday.
You can't let the kids just ride in the back?
I know, just strap them on. That's for another day.
I have a friend who had the larger Tesla, and they fit their 4 kids all into the vehicle. And we're like, how are you fitting those kids in there? They must not have like backpacks or sports bags.
Yeah, that's okay. I can give up the Rivian. We'll just go with the Tesla. That sounds great. Okay. Okay. But there's some benefits. So just to be clear, that you can write off now the interest on an auto loan from a U.S. manufactured vehicle. And that starts when, let me review my notes, tax years 2025 through 2028. Yeah. So
the other one is changing the SALT, the state and local tax deduction. And that goes for 25, right? This goes for this year that you file. And so there's a limitation of $10,000. So for just to be clear here is what you pay in property taxes on your house, the interest expense, the local taxes, all that was capped at $10,000. Now they've expanded that to $40,000. That's going to be that'll be a benefit to a lot of people because that $10,000. Particularly if you live in California.
Especially in California, yeah.
So if you're listening to us and you're out of the state, I mean, you're going to have to look at each state and how that would have an impact on you. But in California, that was a big limitation.
Yep.
Because people who have good properties, they have high property taxes as well as good income. Those can, tie together of where it puts you. So.
Now, another tax credit, we were just talking about, I'm sorry, that was an itemized tax deduction that you were just talking about. There is a difference, right, between a tax deduction and a tax credit. Generally speaking, there's preferential, or it's preferable to receive a tax credit. But one that they're expiring is the child tax credit. They're making the expiring child tax credit, permanent, and they're actually increasing the maximum of $2,200 for the child tax credit starting in 2026. So
let's do a quick kind of a education of the difference between a tax deduction and a tax credit.
So a tax credit reduces the tax liability dollar for dollar.
So if I owe $20,000 in taxes, And if I have 4 children, each one of those children are worth $2,200 times 4. That reduces my tax owed by that dollar amount. Whereas a tax deduction just goes to like your let me say property taxes and interest that you pay on your mortgage. It goes into the deduction. So a credit has a much more impact, has a much larger impact on what you owe in taxes. So,
right. So a tax deduction just reduces your overall tax liability. Right. A tax credit goes directly to dollar for dollar the amount of tax that you owe. So in that sort of scenario, if you were eligible, now there's a max, right? But if you were eligible for $2,200 per child in that scenario, it would be $8,800 that you could deduct directly from the $20,000 that you owe.
What's the maximum? How do we look at the number of children?
Most of these things, it's not the number of children, they phase out with your income. And so a lot of these benefits and these things, they all have these phase outs. And that's part of even that caveat at the beginning to say, we're just getting into this because all of these items have some caveats. When do they apply? A lot of these were 2005 to 2008. So there's kind of a window here. That's part when you think about tax planning, what should be done in the next few years, knowing that after 2008, some of these are going to fall off, like the SALT credit goes back to $10,000. Whereas things like the tax brackets, those just became permanent. And so kind of looking at, what's a benefit now in the short term, what's going to be a benefit in the long term. That's why this stuff gets interesting. And I imagine there's a lot of, CPAs out there that are updating their software. They're getting familiar with these rules because they're going to have to apply these to people's lives to say, hey, if you buy a car this year, if you, have these, this many kids, this is what the benefit's going to be. So. Yeah. So
one that I think actually might simplify the tax code potentially, right, with the caveat, is the way that they've created or changed the itemized deduction for charitable contributions. So prior to this, there was a different rate of how much, like a percentage of the value that you had given to a federally registered charitable organization, right? So for example, like a cash donation to a public charity, that was deductible up to 50% of your adjusted gross income. Donations of appreciated assets like stocks and things, that was deductible up to 30%. So there was different rates at which you could deduct the total value of your charitable contribution. So now they're just making that unanimous, is my understanding. They're creating a 0.5% floor on itemized deductions to charitable for charitable contributions. So I see that as maybe simplifying because there was kind of a difference in how what type of asset you gave.
So again, if you gave money to a private foundation versus a public, there was different tax rates on that. It was very confusing. So if you gave something to a local organization, you didn't get as much of a write-off as if you gave it to, let's say, the Red Cross or something like that. It was just a lot. And whether it be a thing like clothes versus cash, so you always had to kind of keep track of what you were doing and how that had an impact on your deductions. So,
yeah, and you have to always itemize in order to get any sort of benefit for giving charitably. That's changed a little bit as well. There's a little more benefit that even if you're itemizing, you still take some charitable deductions, which they're minimal, but they're great.
Yeah.
All right, we're going to shift. I'll shift just a little bit. Here comes some exciting ones. The ones you've seen in the headlines a lot to say, hey, what about my overtime? What about my tips? Like I've seen that in the headlines.
Wait a minute, can I do that? Can I put my overtime on here? Can I get a deduction from overtime?
I got a tip. I need a tip. Yeah.
Man, I used to live on tips, though. I worked in food service for years as I was putting myself, even in high school, and as I was putting myself through college, right, or trying to fund my lifestyle at that point. So I think this will benefit a lot of workers in food service and other sort of service-related industry.
Yep.
So what this does, from the base level, is someone who is getting tips or someone who is receiving overtime, there is now an element, a portion of that is not taxed. And like I said, there's earnouts and there's limits on all those, but there's about $25,000 of tips. And then what was the other one for the
25,000 joint filers for the premium portion of the overtime compensation.
What the heck does that mean? I love government. I mean, give me a bureaucratic understanding here. All right.
I know.
Bottom line is if I have $10,000 worth of tips over and above my income that I make as a wage,
your wages, yeah.
Can I just put that in my back pocket and not report it? Is that kind of what they're saying?
No, the idea is that you would report it, and you report it appropriately, but you're not taxed on it. It's excluded from your taxes.
Yeah,
so
there's
they
no
want-
like loopholes, like you don't have to report it. Let's be on the up and up here. You still have to report that you received the cash tip.
How many college kids that are working in a restaurant, putting this out through college, are going to write down all the cash tips they have and report that on a tax return? Come on. I think that's the whole point of this, is like, stop it. They're not going to do it. So why make them into cheaters and just give them the benefit? Let them have it.
Is it like, if you can't beat them, join them? Is that what they're saying
Pretty
this
much.
part of the bill is?
Well, again.
And I don't know, back, years ago, you get cash tips, and those, whether you report them or not, you're always supposed to report them, but I imagine a number of people didn't. Today, with tips so often going through credit card systems, I wonder how much that has changed the process to say whether they can be reported or not. But this, to your comment, Randy, I think allows people to appropriately report as they're supposed to, knowing they're not going to be charged. The question that immediately popped to my mind is, what about Social Security? And what about Medicare?
Yeah.
Does that still count for tips or not? And I don't know is the answer. We have to watch take a deeper dive into this, as well as how this gets interpreted by the IRS.
Yeah, because
if I recall from the years that I worked in food service, your wages were drastically diminished because as you declared what cash tips you received and the ones on credit card as well, the overall you still had to pay into Social Security and Medicare, et cetera, and that was burdened on your paycheck. So even though you walked out the door with cash in your pocket, so to speak, you would cash out at the end of the night. Maybe there's a little bit different system nowadays, right? Essentially, you walked out with kind of your gross tips. It felt like I get to keep all of this. But when you actually got your paycheck, which was your hourly rate by the amount of time that you worked, and you had claimed your total tips, right? They had to deduct those government benefits from your paycheck. So my paycheck was almost like laughable, right?
Yeah.
So I think that's still how it's
applied.
applied.
And again, what it does is it makes, again, from a standpoint of accounting, I don't want to get into people, I don't want to regulate people's cash that they receive from tipping. There's a lot of professional waiters and waitresses that this is a profession for them. I get it. But a lot of the service people are part-time people. And now you're grabbing money from them, or you're making them report. I just think it's kind of nonsensical. Why would you track that? It just doesn't make any sense. But again, there are some provisions here. I understand, but I think I think it's a better outcome, right?
Yeah. Well, and the overtime, I think, is a big one. There's a lot of jobs that have overtime. I think a lot of the first responders, a lot of those have overtime jobs. Most anyone hourly in California, if there's any opportunity to work overtime, to get a portion of that money tax-free, to no longer, that's going to feel great for a lot of people's paychecks to say, hey, I put in an extra hour and I got, wow, in California here, it's time and a half for overtime. To say, I got this nice big boost in my take-home pay because not only did I work a little bit of overtime, but that overtime didn't get taxed at the same rates. Same question again, what about Medicare? What about Social Security? Those items, we'll discover those as we get comfortable with this bill. But I'm hopeful that there's people who are working, these hard jobs, especially first responder jobs that see a real benefit, to their monthly income. That would be a great outcome if it was something that was meaningful to those folks.
Yeah, I would venture to guess that they're going to take out the Medicare, Social Security, all that stuff up to the maximum. Social Security goes off after a certain income level. But I would say they're going to grab all that, the federal and the state, they're going to grab all that at that stage. So whatever, they're not going to put a income tax on it, but they're going to grab all the other taxes. Yeah. I would be surprised if they don't.
Yeah.
So this big, beautiful bill, right, is hot off the press. And we've already had clients coming in asking us about it. What do you think about it? Is it a good thing? Is it a bad thing? Right. And the answer is just, it depends, right? There's a lot to it. There's a lot of detail here. And as individuals in the financial services industry, we're trying to understand it so that we can apply it to their scenario, especially those who will benefit. And, the first one that we started with, right, is that estate tax exemption. I think not having to just totally rework estate planning for those who have joint filing under 30 million, that's a huge benefit. So we can take that away as a win.
Yeah. And the other thing that we talk, we're just talking about personal stuff. the bill really deals a lot with businesses. And so small businesses and public companies and what they can depreciate, how they can take advantage of the new code to get better, get deduction so that they can hire more, expand plants, that kind of stuff. There's a lot in that from a business perspective that we're not touching. I mean, that's a whole nother, and a big part of the bill is regarding that. I mean, what Trump wants to do is to give credit to businesses to produce more, to buy more, and to expand their company and to hire more people, right? I mean, that's really what the bottom line. So,
there's a whole other Medicare section that we didn't go into for this podcast of a lot of changes coming through on that side. So people on Medicaid, Medicare, those types of programs, this bill will have impacts, and to understand those, that might be a separate podcast, or someone who's in a healthcare professional, and maybe a better one to kind of speak through that. But the bill is, we're just barely getting into it, and there's a lot more in there. And Randy, to your comment, it'll be interesting as businesses start digesting this, and tax professionals to get that guidance to say, hey, you should do this in these next couple of years, or hey, in 4 years we want you to do this. That forward planning is going to be so valuable, I think, in this moment.
So to our listeners, I think that as the media is reporting how they're interpreting the bill, I think that there's some resources that are really practical and objective. And so you can kind of help guide yourself through an understanding of what the bill actually says and how it will apply to your financial situation. So Jeremiah, what were some of the resources that you found in preparing for our podcast?
Oh, a number of them. I think the hard part is you get these headlines, right? And you open an article and you realize there's no meat here. It's just a headline. And so going to some thicker resources, like there's a few law firms that had an analysis of the bill. There's a couple of tax firms, CPA firms that had some analysis of the bill. And for anyone out there, that's who I would skew towards. I wouldn't do a hot take or a news source or a TikTok, but I'd be looking for who's someone known in this industry as a credible resource. And then the other one is your trusted financial advisors already, your lawyers, your CPAs, your financial planners, connecting with them and saying, hey, what will this do for me? And if you don't have those people in your life, that's what we do, so give us a call, reach out to see if it's a good fit. But that idea, I think there's so much with this bill, there's so much good strategic opportunities for folks, but they're not just going to fall in your lap. They're not going to be things that you get by default. They're things that you need to look at and make some good choices to make sure you take advantage of what is now available to you.
So don't go out and have a bunch of new children.
Is that your takeaway from the bill?
Now, again, you could go out and
not get a rebate.
Yeah, you could go out and adopt 10 children and get $2,200 per. I don't know if that's true or not.
There you go. But reconsider your car options,
For sure.
That's right.
All right. Well, to our listeners, keep listening. We'll have more information coming out as we dive deeper into the big, beautiful tax bill. But thanks for listening today. We really appreciate you. And if you have any questions, of course, write in or submit them. We'd be happy to answer them.
Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricoreadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricoreadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.